Yeah, as I recall, there was a conversation in the early stages of us, interviewing to come out here, where we were asked, hey, if one of you got picked and the other one didn't, would that be a problem for you? And I very politically said, well, we have more fun when we're together, but it would be okay. We'd get over it. And Ryan, I think, said, absolutely not. Huge problem.
It is a huge problem.
But it depends on which one of us got picked and which one didn't.
She's a lot funnier than I am in our evaluation, so I have to bring her with me everywhere I go.
It's true. I do make you funnier.
Yeah. Right. So today we're going to be talking about the One Big Beautiful Bill, and we're going to swap between topics. So we're going to do like a whose line is it anyway kind of vibe. We'll see what happens. Okay. So what we want to do, that was the most heartfelt introduction I've ever received before, which was really nice. What we want to do in the way we structured this class is we kind of dropped it and we said, let's go through the 2025 provisions first, because that's everything you're going to have to know right now when you're working with your clients, when you're answering any client questions. And then towards the end of the session, we're going to go through the 2026 changes and the changes for all future years. But we're just not going to have like an infinite amount of time, because really to go through all of this in detail would take like 4 or 5 hours, right? So we're going to do the best we can to give you kind of everything, but we're going to front load the 2025 stuff and give you as much as we can. And we're going to start that by talking about 529 plans, which I think is your topic.
529 plans. Who's excited? Not everyone all at once. Okay, so 529 plans aren't new. They've been around for a while. Tax Cuts and Jobs Act a couple of years ago made some changes. They expanded the expenses that you could use 529 plans to pay for. These are education savings accounts, so you put money in when your kid's little, the money grows, and as long as you take it out for qualified education expenses, it comes out tax-free, which is great. And so they've kind of been expanding the uses over the years, and then OB3 came in, which, by the way, is what we call the One Big Beautiful Bill Act, in case we didn't say that already.
Yeah.
OB3 came in and expanded it even further, so we have a lot more expenses that we can use these 529 funds for. So I'm not going to go through every single one of them in here, but I do think the coolest ones, if we skip ahead a little bit.
Well, this is for K through 12, right?
Yeah.
So they took it from just tuition on K through 12 to tuition, any of your required materials and supplies for the school. If you've got tutoring expenditures for K through 12, those can count for 529 plan withdrawals, all of that new stuff. Also, if you've got dual enrollment or you've got somebody who is disabled and they need like extra help getting through schools, they need to do an extra kind of program that's specific to their disability, all of those expenses for K through 12 are now eligible for these tax-free distributions. But we will go over here now.
Okay. So this, to me, this is one of my favorite things in the new bill, is this expansion for credentialing programs. We have this sort of idea that everybody needs to go to college and get a college degree, and that's fine for a lot of people. But there are a lot of people who don't necessarily need to go to college. We have skilled trades where you can do a certification program or something like that. And so this new expansion allows for 529 funds to be used for those post-secondary credentialing programs instead of having to be specifically at a university. And so this is going to be for things like tuition, fees, and books for that credentialing program. Also fees for testing to obtain a recognized post-secondary credential. What does that sound like?
So it could be an enrolled agent designation, could be a CPA designation, could be any designation that's recognized by the state or the federal government. And then there are also some independent organizations that kind of maintain what a qualifying post-secondary credential is. In your handout that I would assume would be available for download, we have a list of those organizations that say who is a qualifying post-secondary credential.
And this last one we like quite a bit.
Yeah.
Because you can also use it for fees for continuing education required to maintain that credential.
So now the brass tacks website next to every class is going to say 529 distribution eligible.
Exactly.
We're going to make so much more money because of it.
Fingers crossed.
So one of the things to keep in mind here for these changes is that they're only applicable for distributions taken after July 4th of 2025, okay? But this kind of brings up this interesting question of how far back can I have incurred the expenditure and pull out the funds later? What if I incurred CE expenses, right, to maintain my EA 5 years ago, and I happen to have a 529 account set up? Can I reimburse myself for expenses that I paid for 5 years ago, like you can with something like an HSA? And what's interesting is that Code Section 529 is completely silent to the time requirement as to when you have to reimburse yourself by. Now, the IRS has proposed regs where they say, well, we think that you should probably do it in the year that you paid or incurred the expense, or up to March 15th of the following year, but it doesn't say that in the law. And it doesn't say it in the actual regs itself, it just says it in the preamble to the proposed regs. So it's very possible that you could take a position that you could go back, just like you can with HSAs, to take those withdrawals. Now that would certainly be a more aggressive position. So if you wanted to be a little bit more conservative, you would say, hey, if I incurred some of these expenses in 2025, as long as the distribution came after that July 4th date, we're good to go, it can be tax-free. Go ahead.
All right.
Are the states okay with this? So state of California is not. The question would be, from what I've heard from attendees, New York has a continual conformity to the code unless a specific exception applies. So if New York does not conform to all 529 plan changes, which I'm not sure if there's a rule against that, do they follow or do they not follow? Do they charge tax on the income of the distributions?
Well, it's a deduction here.
Oh, it's a deduction here.
So you don't have that in California.
Right, yeah,
So
yeah.
you pay tax on the whole distribution.
You guys pay,
Essentially, you pay tax on the whole distribution.
do you guys pay tax on the whole distribution from the 529 accounts?
If you don't use it.
For qualifying expenses. So if they don't differ on the qualifying expenses, then they will probably follow this, but I would have to go look.
They don't follow K-12.
Okay, if they don't follow for K through 12, just like California doesn't follow for K through 12, then no. But the one for the post-secondary credential is not in the K through 12 part of 529. So that's going to be weird. Go ahead.
All right, cool. Standard deductions are now permanently increased to these higher TCJA numbers and indexed for inflation. So our 2025 numbers, $15,750 for single or married filing separate, $23,625 for head of household, and $31,500 for married filing jointly. These are the kinds of numbers that I never actually memorize because I can just look at a piece of paper next to me and see them. And
Yeah.
they change every year. Who has space for that in their brains?
No, not me.
Nobody.
You want to talk about this one?
I do kind of.
Okay,
we
go
can.
ahead.
Well, I mean, we can share it.
No, no,
I'm
no.
generous. You
No.
got the mic that you get to pin on yourself, so I get to choose what I talk about. All right, the senior deduction. So this one I feel like has had a fair amount of misinformation around it. Because what it started out as was no tax on Social Security, right? I don't know.
It's
who
a
did
pipe
say-
dream. They're not allowed to do that in reconciliation. Sorry. Anyway, go
All
ahead.
right. Wait your turn. I'm just kidding. So the idea was no tax on Social Security, and what we ended up with was this new senior deduction. Now, part of the problem is, I think it was the Social Security Administration,
I'll show
right?
you. I have the
Yeah,
thing
we've
in
got
the
a slide in
slides.
there. There was misinformation from everywhere on this one. And one of the biggest things was that, first of all, Social Security is still taxable if it's taxable for that taxpayer. Nothing about that changes. But what we do have is this new up to $6,000 deduction for taxpayers who are 65 or older at the end of the tax year. Whether or not they're receiving Social Security, that has nothing to do with their eligibility for this deduction at all. So you could be over 65, pushing off taking your Social Security, you could be ineligible for Social Security, and you can still get this deduction. It's only for 25 through 28. Some of the provisions are permanent and some of them expire at the end of something. Something
The
happens
current
at the end of
administration?
28.
Yeah.
Yeah, that's weird.
We're from California, obviously. It's a joke. It's a joke.
We have fun. There is a phase out on this. It starts to be phased out once AGI hits 75,000 or 150 on a joint return. And MAGI for almost all of these new provisions is just income without plus the foreign income
it's your AGI,
exclusion.
and then you add back any excluded foreign income.
Yeah, mostly foreign items get added back in. You have to have a Social Security number in order to claim this deduction. In the original bill, I think in the House bill, they both had to have it, but it ended up being switched back, right?
Just the
So
person
just the
who's
person
claiming.
claiming it has to have a social security number. But this isn't going to work unless they have that valid social. It is not an above the line deduction. Everybody kept saying that it was. It's not. It doesn't reduce AGI, but it does reduce taxable income.
Yeah, it's also not an itemized deduction. So this is one of like the new 4 horsemen deductions, right? Senior tips, car loan interest, and the other one that overtime. There's a new schedule, Schedule 1A, that you will see when you file 2025 tax returns.
Has anyone looked at that schedule yet? Did you notice what each of the headings is? Because I think it's hilarious. No tax on tips, no tax on Social Security, no tax on overtime.
Does it say no tax on Social Security?
Or maybe
No,
it says
that
senior
one
deduction.
says senior
That one might say
deduction.
senior
They
deduction.
weren't that
But I
brazen.
do love that they did say like no tax on tips, even though that's not really what it is.
Yeah.
Yeah, so those are fun.
Okay, go ahead.
So we have an example here. We didn't get very creative with this example.
No, we did not.
Interesting. So at the end of 2025, Gerald will be 88 and Samantha will be 62. They filed a joint return and they have MAGI of $175,000. Their senior deduction is $4,500, which is Gerald's $6,000 less $1,500, which is 6% of $25,000, which is how much their AGI goes over the threshold.
Yeah.
So they're going to have a little bit of a reduced deduction.
So
there.
let's talk about those phase outs, right? If the modified adjusted gross income for any taxpayer other than married filing joint goes over $75,000, then for every dollar you go over, you lose 6% of that dollar on your senior deduction. For married filing joint, it's $150,000 for that phase out, okay? One other thing to point out here is that if Samantha was also age 65, you would have 2 $6,000 deductions, okay? But you would apply the phase out equally to each deduction. Okay, if you're married, got to file a joint return. There is a considered unmarried. If you're familiar with the rules for considered unmarried for head of household, it's very similar, okay? And this is the Social Security statement where they said that Social Security wasn't taxable for 90% of Americans because of the senior deduction. So, yep. The senior deduction is a standalone deduction on the return. So it's separate from standard deduction and itemized deduction, which you still qualify to claim. Yeah, go ahead.
All right, up next we have the car loan interest deduction. This is another brand new deduction, also called no tax on car loan interest. And so what this says is if you buy a passenger vehicle and you meet certain income requirements, you can deduct up to $10,000 of car loan interest on your return for the year. Now, I don't know who within these income thresholds is buying a car that's going to have $10,000 of car loan interest on it, but apparently that's the threshold they decided to set.
Hey, some car loans are 18% if you have bad credit.
All right,
It's
fair
bad.
enough.
It's a sad state of affairs we have.
Yes. So it has to be a qualified passenger vehicle. And I really like this. You can use it for, it has to have at least 2 wheels. So that means motorcycles count. I've been eyeing a new Vespa, so I might try to, I think the AGI limitations are going to push me out. But I could potentially deduct the interest on my Vespa if I met those requirements. So the final assembly has to occur within the United States. It has to be original use with the taxpayer. So I can't buy a used car and deduct that interest. It has to be original use with me. Has to be manufactured primarily for use on public streets, highways, 2 wheels, but it could be a minivan, an SUV, a pickup, or a motorcycle. And it has to have a gross vehicle weight rating of less than 14,000 pounds.
Yeah, now this one kind of trips people up. Treated as a motor vehicle for purposes of Title II of the Clean Air Act. It does not mean it needs to be a clean vehicle. That is a title where they basically describe all of the eligible manufacturers, which is pretty much every manufacturer that you could ever think of. Honda, Toyota, BMW, Mercedes, Audi, Ford, GMC, Rolls-Royce, all of those manufacturers are under that section. Yeah?
Where do you find out where your car is finally assembled?
Yeah, that is a great question that I don't have an answer to. What they did with the clean vehicle credits is they had a dedicated website that was referenced in the instructions. They haven't released the instructions for Schedule 1A yet. They've just released the schedule, unless I have missed that in the last 24 hours. So in there, hopefully they'll have a website where you can check that. Yes?
Some of the manufacturers list the point of final assembly on the window sticker.
Yeah, so his comment was that some manufacturers will list the point of final assembly on the window sticker. Oh, yeah? Okay. Okay. Go ahead.
All right, so you have to
We gotta keep
include
moving.
that VIN on the return, which is always fun. It's fun to track that information down from our clients. There's supposed to be some sort of a reporting form that we're going to get here, but I was just looking about 25 minutes ago at some of the updated information about this deduction, and we still don't know exactly what that form is going to be. It'll be some sort of a 1098, I imagine.
No, it's a 1098 CLI.
Is that
car
what
loan
it is?
interest.
Because I was looking at it and I didn't see anything in there.
Yeah,
but
they have a
fine.
draft. They have a draft form.
Okay, well, I don't know what I'm talking about. So we have this new form, so they're going to give us that. There is some transition relief for the car loan payees or payors. So the people receiving the interest have to report the interest they received on this new form, but we do have some transition relief for 2025. The income phase outs for these are 100,000 single, 200,000 joint. And you don't have to file jointly if you're married. There are a couple of these new deductions where you have to file a joint return, but this one isn't one of them. Using married filing separate, you could potentially get up to a $20,000 deduction. Normally with married filing separate, everything gets cut in half, but this is one where you may actually get a bigger benefit by sneaking that through. And MEGI, again, it's the AGI plus that foreign excluded income.
Yeah, we can take one question. We got to move through some of this stuff a little quick, but go ahead.
Will the banks be giving the interest amount to us, or do we ask for something?
So the banks are supposed to issue, there's a new form that's like an information reporting form, like a 1098. I believe it's the 1098 like CLI for car loan interest. But yeah, you're supposed to get a form for it. If you don't get it for 25, you will certainly get it in future years because it'll be in full force by that time. Yes, and then we got to move on.
Does this apply to cars that are only purchased as of like a certain date, or could it be a car that was purchased new in like 2022, for example?
It could have been an older car, but the debt has to originate after December 31st of 2024, which means that if you had an older vehicle, you'd have to refinance it in order for it to qualify. Okay, so let's talk about the tips deduction. This is a mess, and it got even worse when the IRS released their proposed regulations on it. It's not in the proposed reg stuff is not in your handout, but I am going to talk about it so that way you know what's coming. So the idea for the tips deduction, you get a deduction for qualified tips up to $25,000 per year. Again, this is only available 2025 through 2028. And again, it's one of those Schedule 1A deductions, so it doesn't reduce AGI, but it does reduce taxable income. Okay? So what is a qualified tip? It's any cash tip, but a cash tip includes something that is charged to a card, like a debit card or a credit card could be eligible as well. They also say an equivalent to actual currency. So if I'm at a casino and I'm playing blackjack, which I frequently do, and I tip the dealer with a $5 chip, that can be a qualifying tip for the purposes of this deduction. And so that dealer would get a deduction theoretically on their tax return for those amounts. Now, eventually, this is going to have to all be separately stated on the W-2. The qualified tips are going to have to show up there, and the trade that they operate in will also have to show up. We'll talk about why that's important a little bit later. But for 2025, we got transition relief, and so they basically are telling us, hey, just look at the box 7 on the W-2 to see what are the Social Security tips, and then use that amount for 25 only, okay? Tips received under a tip sharing arrangement can qualify. The proposed regulations also say that if somebody receives a tip in the form of like a sporting event ticket or in the form of most types of cryptocurrency, that is not eligible. Okay, so a qualified tip for the purpose of this deduction, it's got to be voluntary. So if you go to a restaurant and they charge you a mandatory 18% gratuity that you cannot modify, that doesn't count. Now the interesting thing is that a lot of those restaurants, even though they're not supposed to do this, they call it a qualified tip on the W-2 anyway, right? So hopefully we'll see some of these restaurants actually properly report this because again, those mandatory, those mandatory service charges are not eligible. Now, if they put the 18% on the bill, but you're allowed to modify it by saying minus such and such amount or plus such and such amount, then it's still considered to be voluntary, okay? So tip good, service charge bad. Alrighty. If, and this is where things are going to get weird, you are operating in a specified service, trade, or business, the tips you receive are not eligible, okay? You also have to have received the tip in connection with a business that customarily received tips prior to 2025. So if you're a tax professional, you cannot switch to receiving tips and get a deduction for two reasons. The first is that we didn't customarily receive tips prior to 2025. While that might be true for you personally, it's not true on the broad scale. And the second is that what kind of business are we? A specified service trade or business. Yeah, so we are not eligible. Now, in the proposed regs, they gave us this list of all of these like customary industries where tipping was a normal thing. And it's interesting because in a lot of them, they actually are specified service trades or businesses. So why did they do that? Well, it's because if I am employed by a business, I don't look to whether the services rendered by the employee are a specified service trade or business. I look to the employer to check to see. And so they give you this perfect example in the regulations where you have a pianist, right? That's performing arts. That's an SSTB, okay? But the pianist is an employee of a hotel. And the hotel pays the pianist as an employee to play music in the lobby. The hotel is not a specified service trade or business. So the tips received by the pianist in that case are eligible for the deduction. But if the pianist was an independent contractor and the hotel just paid them as a contractor by a 1099 or something like that, guess what? The pianist is an SSTB, they're self-employed, they are not eligible. Now, you can be a self-employed person and claim the tips deduction. That is allowed. But again, you can't be operating in a specified service, trade, or business, okay? How easy is that? It makes perfect sense, right? I know, yeah, it's ridiculous. Okay, the tips must be reported on one of these information reporting forms, a 1099 NEC, a 1099K, or a W-2. And the rules say that they're supposed to be separately stated on those information returns, okay? For 2025, they provided transition relief. While they told us that for 2025 for the W-2, just look at the box 7 amount for the Social Security tips, they did not say what we're supposed to do for self-employed individuals receiving a 1099K or a 1099 NEC. So we have yet to see any guidance for those self-employed individuals. If the amounts are not reported on a W-2 and you're going to be an honest taxpayer, I've rarely seen this form ever be filed, you can file the form 4137, claim the tips there as income, and then take a deduction for it after. But that way you're paying the Medicare tax, right, and the Social Security tax. So I know. Okay. Again, got to be a trade or business that customarily receive tips. And if you are a self-employed individual, you have to look at the net income of the business because the tips deduction is limited to the net income of that trade or of that business, okay? There's an MAGI phase out that applies. This one is really weird. So for most taxpayers, if their MAGI, their AGI plus any excluded foreign income, goes above $150,000, then for every $1,000 you go over, you lose $100 on the deductible amount of your tips. If you're married filing joint, it's $300,000. We'll show you an example of that phase out in just a moment here. Any qualified tips deduction you claim will directly dollar for dollar reduce your QBI. So you might have somebody who is like a driver for Uber or Lyft or something like that. Maybe half of their income comes from tips, right? And after you figure for their deductions, it might be all of their net income that comes from tips. And so they would get the full deduction, but if it's all of the income of the business, they would not get any QBI. So they're still getting a larger benefit, but they're just not getting the double dip. Okay. Taxpayer has to have a Social Security number valid for employment. Married taxpayers must file a joint return unless you are considered unmarried. Okay. So in our example here for 2025, we got Matt and Lindsay who are married. They file a joint return. They've got AGI of $315,600. Matt has a Schedule C business doing Instacart deliveries. His net income was $4,320. For this business, he received $7,810 in qualified tips. How could he have gotten that much in tips, but his net income is only $4,320? Because he's got to pay for gas and all the other expenses of his business, right? So how's this going to look? So because his net income from his business was only $4,320, that's what we are limited to for our tips deduction, okay? But because their AGI goes over $300,000, we've got to do a reduction. Now they are 15 times, or $15,000 at least over the 300 grand, and so we have a $1,500 reduction. So their qualified tips deduction goes from $4,320 down to $2,820, and their QBI will be reduced by the $2,820. Again, it's very simple, right?
But he's not even going to get a 1099K.
So he is going to get a 1099 NEC. And they provided transition relief for 2025, and they said it doesn't have to go separate on the 2025 1099 NEC. But in future years, whoever, did I say Instacart? Instacart is going to have to separately state his tips on that 1099 NEC in the future. And we don't have any guidance on what the transition relief looks like for now. But most of these drivers will be able to log into their online account and see how much of their income was from tips. Yes, and then yes. So for every 1,000 you go over the 150,000 of the 300,000, you lose $100. There is no fractional amounts. Yes.
The draft 2026 1099 NEC is out, and it does have a box for overtime after tips. Can like in the overtime? Maybe I should wait till you get.
I'll get to overtime. Yeah.
But isn't these designed for? Aren't these designed for employees?
So.
Is it possible that an independent contractor can have overtime?
An independent contractor can have tips, but I believe from the way I read the statute, you have to be an employee in order to get qualifying overtime, which we'll talk about later. Yeah, which is, yeah. We've seen them make mistakes before.
What?
Okay, do you want to talk about overtime? Do you want me to talk about overtime?
You talk about overtime.
Okay, so
you love this one.
There's also a new deduction for qualified overtime as well. This must be overtime that is required under the Fair Labor Standards Act, which means the time that when you go over the 40 hours for a given week, that 1.5 times amount, that's what you're going to be looking at. And I'll show you how we calculate it because it's not the whole amount of the overtime that is eligible. So it's only the overtime that exceeds the regular rate. So if I'm making $20 an hour and I do my 41st hour for the week at my job, how much will I make for that 41st hour? $30 an hour. So $30 an hour exceeds my regular rate of $20 an hour by $10. You get the deduction for the 10, not the whole 30. Everybody see that? You see how they do this fun stuff? Oh, there's no tax on overtime. Well, there is on 2/3 of it, yes.
Speaker Ryan, way back when, promised us postcard printers. Have we issued a bolo as to where they are?
Postcards? Oh, the postcards for the 10. No, there is no postcards. They've abandoned that concept entirely, yes.
When you have construction and you are doing government contracts, overtime is also calculated on the bennies. So that if you have to pay, into their annuity fund
Uh-huh.
and health and welfare, all that stuff, overtime is calculated on that also.
Yeah.
So how do you handle that?
That is a good question because one of the messed up things that they did here is they combined the Internal Revenue Code with the labor code sections. And unfortunately, I'm not a labor law expert. And so that makes it hard for me to address some of those more nuanced questions. I am not 100% sure. Hopefully, we'll get guidance on things like that soon. Yeah. I wish I had a better answer for you. I'm sorry. I know. I'm not perfect. Okay. The maximum amount allowed as a deduction is $12,500, but it could be up to $25,000 for, wait, hold on, that's not right. Yeah, $25,000 if married filing joint. And then the MAGI threshold is $150,000 or $300,000 for taxpayers who are married filing a joint return. Married taxpayers have to file jointly, but you can have this considered unmarried thing where they can file separate. Okay, so there's an example in your book, but it's basically what we just went over, where you look to see, okay, I'll just do the example. Saul's an overtime eligible employee, makes $18 an hour. His MAGI is $53,500, so he's way under the phase-out threshold. He did 27 hours of overtime at $27 per hour, and so his overtime earnings were $729, okay? So his overtime deduction is going to be $243, which is 27 hours times the difference between the 18 and the 27, which is $9. So it's kind of a piddly deduction, but at least he gets something, right?
And he's going to be really excited to see his bill for calculating this deduction for him.
Yeah. $243 for a $243 deduction. That sounds about, I like that. I like this guy.
Exactly.
Okay, go ahead.
What's your deduction? That's the fee. All right, state and local taxes. Who's excited about this one? Hey, it should be everybody in this room. We're from a high tax state. This is a pretty high tax state. I'm excited about this new increase in the state and local tax limitation because that $10,000 hurt, right? It hurt here, it hurt where we are, and it felt a little bit targeted kind of at these coastal states. But so we get an increase now for 2025. It goes up to $40,000. There are MAGI phase-out thresholds on this, but this is going to make a huge difference. I've been running scenarios for my taxpayers for next year, and already huge differences for a lot of my clients just with this increase here. We've got some inflation-adjusted amounts going through 2029, and then for 2030 plus, back down to 10. So we'll see what happens.
Yep. Married filing separate, cut those all in half.
Yep.
Here are the phase-outs. Go ahead.
No,
No, you got it.
But
No, you got
after
it.
you,
No,
by
no.
all means. So here are the phase-out thresholds. Those are also inflation adjusted, so you can see going through for 2030 plus, we don't have a phase-out because we drop back to the 10,000. This will never go below 10,000. So when you hit the AGI phase-outs, it'll drop down and down and down until it hits 10, and that's where it stops. So you're always going to get at least 10,000 of state and local tax as a deduction, no matter how high your income goes.
So we are good friends with Tom Gorzinski, who some of you may know.
Humble brag.
And he ran an analysis on this. And so what you'll find is that the phase out, it says for every dollar you're over the 500K, you lose 30% on that dollar. So at what point of MAGI are you totally phased out of the 30,000 increase? $100,000, okay? So what you will find is that because this phase out happens so fast, any kind of deduction you can get your client, if they're in the $500,000 to $600,000 of MAGI range, will save them far more in taxes than just their tax rate because of how fast this adjustment changes. So if you have any clients who are in that $500,000 to maybe $620,000 range, anything you can do, retirement plan contributions, putting more money into their business, those things will make a massive, massive difference for tax planning, okay? Okay, we taught MAGI is same for here as it was earlier. It's just AGI plus any excluded foreign income. And then Shannon mentioned the floor. Go ahead.
All right, so we've got an example. Salty Sam. This is a little more in keeping with our example style here. He had AGI of $570,000, no foreign earned income or income from U.S. territories. His state and local taxes that he paid for 2025 were $60,000. So what is his allowable SALT deduction on the 2025 Schedule A? Real quick, did anybody call it SALT before TCJA? This is my casual poll. I had to Google it the first time I heard it. I was like, what the heck is the SALT deduction? And now we all call it that. So what is his allowable SALT deduction?
So is he going to get the full $40,000? No. How much is he over the phase-out threshold? $70,000. Quick, who can do 30% of $70,000 in their head? Whoa.
Impressive.
Hold on, is that right? Yeah, it is. $21,000. Yay.
Yay.
I'm not a math guy, I'm a rules guy, okay? So 21,000 is going to be his reduction. So 40,000 minus 21,000 is what? 19,000, and so that's the maximum amount of allowable SALT. Everybody good? Cool. Yes? It's the same for single and married filing joint, just like it's the same right now. The difference is for married filing separate. For married filing separate, you cut everything in half, which is a reason not to get married.
Yeah, Ryan's a big fan of RDP.
Yeah, do you guys have registered domestic partnerships in New York? No, we have them in California, and because they're still community property, there's a lot of tax tricks you can do. It's very exciting. Go ahead.
So what if his AGI was $610,000 instead?
Quick, how much does he get? 10. He'll get 10 because there's a floor. Yeah, floor of 10.
Yep, so he still gets his $10,000, but that's it.
Okay, so we're going to breeze through this section right here. Qualified disaster loss. So this is something that was introduced a number of years ago. I don't remember what bill originally brought it about. But traditionally, if you suffered a loss as a result of a federally declared disaster, the loss that you could claim on your return, you had to reduce it by $100, and then it was subject to a 10% of AGI floor, right? Which hurt a lot of people. Then they introduced these things called qualified disasters. And they said, hey, if the federally declared disaster occurred within a certain period of time, then instead of applying the $100 and 10% floor, you can just apply a $500 reduction and no AGI floor. And so basically what they did is they kicked out the date here all the way to disasters that ended on January 11th of 2025. Okay, so just more disasters are eligible. I cannot tell you all of the eligible disasters on the East Coast. You're going to have to go and look. Okay. All right, go ahead.
So we have HSAs. Now we can, if you have a high deductible health plan that offers telehealth or other remote care services, you can use HSA funds to pay for those. We've got a little bit more on HSAs later on, but that's for December 31st and forward, 2024.
Yeah, so 2025 plus. Yep. Okay, R&D credits and R&D expenditures. How many of you actually have like a good part of your practice that's on R&D? Does anybody have at least one client that has R&D? Okay, for you guys, I'm just going to go over it real briefly here. One of the bummers with the Tax Cuts and Jobs Act is that from 2022 forward, they required you to amortize your domestic research expenditures over a 5-year period, and your foreign you had to amortize over a 15-year period. They did not change foreign expenditures with the bill. It's just the domestic stuff. And basically, they kicked it back to the old rules for the beginning of TCJA, which is that if you incur domestic R&D expenditures that you use to claim the credit, you're allowed to deduct those in the year that you paid or incurred them. But the interesting thing is that while it says that this change is effective for taxable years after December 31st, 2024, they did something weird with the older R&D expenditures from 22, 23, and 2024. So let me just jump over to that real quick here. So what we are allowed to do for those older years where we would have amortized the domestic expenditures over a 5-year period is you have two types of taxpayers. You have all of the taxpayers in one category, and then you also have something called an eligible small business, which is a business whose gross receipts for the 3 prior years average out to less than $30 million, okay? The smaller businesses are allowed to go back and amend their 22, 23, and 24 return to just claim all of the R&D that they paid in those old years, okay? But if you have a larger business that has average annual gross receipts of more than $30 million, they are not allowed to go back and amend. They have to do something else instead. So they're going to have to do one of these two options here. For your larger businesses, or for any business that wants to, you can elect to accelerate all of your remaining amortization from the R&D expenditures from 22, 23, and 24 into the 2025 taxable year. So that's your first option, okay? Your second option for all taxpayers is that you can take the remaining amortized amounts or unamortized amounts from 22, 23, 24, and you can expense them half in 25 and the remaining half in 2026, okay? So you're going to have to do some tax planning with your clients to decide which of those two options may be best. Or again, for your smaller businesses, you may decide, hey, it's better to go back and amend those old year returns. You'll get a greater benefit. One second, let me go through this first, and then I'll get to your question, okay? So Spine Corp is a calendar year C corporation with 2025 gross receipts of $14 million. Excuse me. For the prior years, their gross receipts were for 2022, $10 million, for 23, $20 million, and for 24, $15 million. Does that average to more than $30 million? No. So they're an eligible small business. They are allowed to go back and amend. In 2023, it incurred $300,000 of domestic research expenditures and deducted them as follows because it had to amortize them. $30,000 in 2023 and $60,000 in 2024. So let's look at their options. So if they want to, they could just continue to amortize. That's always an option. You don't have to accelerate those amounts, okay? So they could just continue on with where they were at. Alternatively, they could go back and, what does this first one do? Amend its returns to claim the deduction because it's an eligible small business. So what they would do is they would go to the 23 return where they had originally only deducted $30,000 of expenditures and deduct the remaining $270,000 of expenditures. But when they do that, they used up all those expenses. And if they filed their 2024 return where they claimed an amortization deduction for $60,000, what else do they have to amend? Their 24 return to remove the $60,000 that they had claimed in amortization from those 23 expenditures, okay? So little tricky there, Now, yeah, so in the real world, you're probably going to have some R&D every single year, right? And so if you're going to go back, you're going to have adjustments in all of those years, right? To accelerate the amortized amount, to do the reduction in the next year, but to increase it by the expenditures incurred there, absolutely. Unfortunately, I can't do everything here, but yeah, that's the concept, right? There's another thing that came out. The IRS released a revenue procedure where they said if you want to, for these eligible small businesses, you can accelerate everything into 24. But you have to file that return by November 15th of 2025, which gives you 3 weeks to figure that out. Good luck.
With respect to the small business option,
Yeah.
does the business have to be operating as of 12/31/21? Do you have to have income and expenses in all 3 of those years?
No. There's no requirement that the business was operating for that whole time period. So if they had started up in 23, these same rules could apply to that entity. Yeah, they do something in the 448C gross receipts test where if you weren't in operation for all those years, they have a modified calculation that you can use.
On the research, 22, 23, did you always have to amortize it? Because it didn't make sense if you had a profit and you didn't write off all your expenses. But did you have to, the research and development, did you have to advertise it? Did you have to categorize it?
So yeah, his question is about the old requirement to amortize and whether it applied in all cases. It applied in all cases. But if they were operating in a net operating loss, then you would just be modifying the NOL, right? So that would get a little tricky. Okay. And then they also, if they don't want to do that, they could accelerate the remainder into 25 of the 23 amount, which would be 210,000, or they could split it in half between 25 and 26. Super easy, right? I know. Okay, you want to talk about bonus?
I would love to talk about bonus. So bonus depreciation, this is an accelerated depreciation. We love bonus. We had 100%, and then it started to phase down little by little, right? It went to 80, and then it went to 60, and then it was down to 40, and that was kind of a bummer. We have 100% bonus depreciation back.
With caveats.
This guy. Anyway, yes, with caveats. So if the taxpayer acquired the property and placed it into service after January 19th of 2025, 100% bonus. If it was before January 19th of 2025, 40%.
Yeah, so if you had acquired the property on or before January 19th of 2025, you are subject to the old Tax Cuts and Jobs Act phase-out rules. So this would continue to apply even after 25. So imagine for a moment you had bought an asset on January 1 of 25, but you didn't place it into service until July of 2026. What would be your bonus depreciation rate? 20 in 2026. Because remember, it continues to phase out. And what if you had bought it on Jan 1, 25, but you didn't place it into service until 2027 or some later year? What's your bonus now? 0. Okay? So that acquired date is very, very important.
That January 19th date, though, that's kind of specific, right?
To what?
I don't know. What happened? Anybody know what happened on January 19th?
Thank you so much.
It was the inauguration. So if you bought your property before the inauguration, even if you placed it in service after, you get the old bonus depreciation rules.
Hey, but there's a fix for that, right?
Is there?
I don't know. Is there? Where is it? There it is.
Hey,
There's a
there
fix.
is. It's 179 expensing. So if you have that reduced bonus, so let's say you bought a piece of property on January 1st and you didn't place it into service until after, or even if it doesn't matter. You bought it on January 1st, you placed it into service February 2nd. So you get your 40% bonus, but you're not stuck, you're not out of luck for the rest of the year. You can use 179 expensing to deduct the rest of the cost of that item. And it's been increased now, and this one actually does go into effect December 31st of 24.
No, after December 31st of 24.
Yeah.
Yeah.
So for tax years after December 31st.
Yeah.
So even if you bought your property on January 1st, you can still use the increased 179 amounts. They didn't put that weird January 19th date on this one.
Yeah, so they jumped it up to $2.5 million.
Yep.
From the old 1 million or whatever it was indexed to.
1.25-ish that we had.
Yep, and then the phase out they increased to $4 million. But this also still obviously comes with all the caveats of 179 expensing, right? For recapture and also for the taxable income limit. So this won't help pass through entities that are trying to pass out large losses.
I just took a look, both the R&D and the bonus depreciation provisions are non-conforming to New York State purposes.
Thank you. Yeah, so New York, non-conforming for bonus, Non-conforming for R&D.
They say they may issue it, which probably won't take place until next year's budget, which means if you want to do a return by November 15th, take out a dartboard.
Yeah. Yeah, good luck. All righty. Oh, I have to talk about this, huh?
You have to talk about this one.
Okay,
You like this one.
so there have been lots of weird things that Congress has done with non-residential real estate over the last like 40, 50 years or whatever. There used to be an election where you could apply like double declining balance or declining balance. That was prior to 1986, I think. I wasn't alive then, so I couldn't tell you. But they've done another weird thing here with non-residential real estate. So normally, how long do we have to depreciate our non-residential real estate over? 39. 39, straight line, okay? This provision will allow you to fully expense a building in the year you place it into service. Yeah, but it's only for certain types of buildings, and there are very strict time requirements. But doesn't that sound exciting? We'll talk about the pitfalls of it in a little bit, okay? So this is our new deduction for qualified production property. I'm going to define each of these bullets in more detail as we go through here. The non-residential real estate has to be an integral part of a qualified production activity. So you cannot buy a building for your tax office and write the whole cost off. That's not going to work. But if you got clients that are involved in some form of manufacturing, this may be an option for them. We'll talk about the requirements in a little bit. Got to be in the U.S. or a possession of the U.S. The original use generally has to commence with the taxpayer. So what does that mean, usually? That you have to build the building. But there's a save for that where you can buy a building. We'll talk about that a little bit later. The construction has to begin after January 19th of 2025. What a coincidence,
Weird.
right? I know. And before January 1st of 2029. It's got to be placed into service before January 1 of 2031, but it can be delayed if there was a disaster that occurs in the future. Who knows? And then you have to elect this treatment. You may not want to elect it. We'll talk about why a little bit later. Hello? Okay. Leased property does not qualify. So if I own a building and I take on a new tenant and they turn it into a manufacturing facility, I, the landlord who owns the building and collects the rent, I cannot apply this treatment, okay? It's got to be the taxpayer producing the thing that owns the property. If you want to buy a used building, this is how you do it. So you have to have acquired the property again after January 19th of 2025 and before January 1st of 2029. And then the property cannot have been used basically for manufacturing or to produce a qualified product from January 1st of 2021 through May 12th of 2025. I'll show you an example of that in a little bit. The property cannot have been previously used by the taxpayer prior to the acquisition. So if I was paying rent to a landlord to run my factory, and then I hear about this and I buy the building, that's not going to work because I would fail that second requirement. And the third requirement is that you cannot have inherited the property, you can't have received it as a gift, and also, what's that third one? You can't get it from a related party. If you entered into a written binding contract to purchase the property on or before January 19th of 2025, I am so sorry because you already planned to do that. It's not eligible for this treatment. They exclude certain types of property, your offices, your administrative suites, any sort of lodging or parking, a place where you conduct sales activities. Those types of properties will not qualify. What is a qualified production activity? It means that you manufacture, produce, or refine a qualifying product. And a qualifying product is any tangible personal property as long as it's not food or beverage that is also sold out of the same building. Okay? So like if I owned a deli and we actually get the raw meat in, we treat it and prep it to sell, and we sell that same meat. at the same establishment, that won't work, okay? But again, got to be tangible personal property. And then the activity has to substantially transform the property comprising the product. Now, up here, there are these three terms that I just said: manufacturing, production, or refining. Production, you only use this term when you're talking about things that are agricultural production or chemical production. But if I'm manufacturing a physical product, even if it's not agricultural or chemical, it can still qualify under the manufacturing or the refining item. Okay, here's our big example. This is going to help to bring it all together. Manufacturing Mark really likes action figures. He purchased a commercial warehouse in August of 2025 for $7 million. The building is valued at $5 million at the time of the purchase. Did he buy the building at the right time? Yeah, it's after January 19th of 2025. Now, he didn't build it himself, but can we get around that requirement? Yes, we can. The commercial warehouse was previously used for storage, and let's assume he did not buy it from a related party. So can we get around that requirement for original use of the property? Yes, because it wasn't used in a production activity for that time period of 21 through 2025. He purchases machines and equipment to produce the action figures. The commercial warehouse is then placed in service in December of 2025. Is that a good date? Yeah, as long as it's after January 19th of 25 and before December 31 of 2029 or January 1 of 2030, sorry, then we can qualify. He sources the plastic, paint, and cloth materials to create the action figures. Is the purchase of the warehouse treated as a qualified production property? Yeah, he's going to source all of these items, and he's going to manufacture a qualifying product because the action figures are tangible personal property, right? It's a physical thing that you can pick up and move. So it could be qualifying. So what happens here? Because we meet all of these requirements, he can elect to treat the property as qualifying production property and deduct $5 million in 1 year. Doesn't matter if he had to take on a mortgage to do it. Could have only put $500,000 down or $1 million down on the property, still gets to deduct the full thing, provided he meets all of the other basis requirements that you have. But if he buys it personally or in a sole proprietorship, this is going to be qualified non-recourse financing. So he'll get basis for all that debt. Yes?
But because this is depreciation, this turns his basis in the property to zero?
Oh, you wait. Just you wait. I'm gonna get there. I'm gonna get there because you're on the right track, okay? It's actually gonna be far worse. Yeah, okay. All right, now, what if Mark does not source the plastic, paint, and cloth materials and he buys pre-made action figures and he just paints them? Is he substantially modifying or transforming the product? I don't know. Maybe. We don't know. We don't have any guidance from the IRS, so it's kind of, questionable. Because again, you have to substantially transform the items that comprise the qualified product at the end of the day. Okay. Yes?
So if you were to buy action figures that were completely white, no features at all, but then he would spend the time and paint it completely to make it something that's basically completely different from what he bought it, that sits in a gray area?
All of it sits in a gray area right now. What you think is a substantial transformation and what I think is a substantial transformation and what the IRS and the courts think of as a substantial transformation, they could all be totally different things. Yeah. I want to keep going here because we're going to run out of time if I spend too much time on this. The deduction is allowed for regular income tax purposes and also under AMT as well, so you won't have a huge AMT liability as a result of this. You are allowed to elect out for this qualifying property, and if you use the ADS class life, there are some special rules on that. Okay, to your question. Yes, it is a form of depreciation when you call it qualified production property and you write the whole cost off. And yes, it will drop your basis down to zero. Normally, when we depreciate a building and we use either a 27.5-year life or a 39-year life, what do we do when we sell the property? we have 1250 unrecaptured section 1250 gain, right? Which is at a maximum rate of what? 25% for that. Collectibles is 28. So 25%. When you apply the rules for qualified production property, you turn the entire property into 1245 property. So when you sell the property, what happens? Ordinary income. Probably most of it at the 37% rate, right? Because that's a huge deduction. So that's something that you've really, really got to be aware of. Now, in addition to the fact that it's 1245, let's say that, let me just do the example before I tell you what the rule is, because I just want to shock you for a moment here. It'll make me feel good. In 2030, Mark decides that making action figures is exhausting, and he converts the warehouse back into a storage facility. You think you can get away with that? No, no. If you change the use of the property to where you're not manufacturing a qualified product anymore, within the first 10 years of the activity, you recapture all of the 1245 that you got. So what should we tell Mark to do? Hire somebody, keep suffering. I mean, like, I'm not going to lie to you. That's really attractive to get a $5 million deduction, especially for a high-income taxpayer, right? But we do need to be cautious about what their long-term plans are. So if he does drop out in 2030, he has a $5 million gain inclusion event, and his basis in the warehouse will go back up to $5 million at that point in time, because he still owns the property, right? Oh, dude, it's like we have the same brain. Okay? So let's say we convince Mark, no, don't stop doing manufacturing, okay? Keep it. So he holds it until 2040. If he sells in 2040, and he just sells the property, what's going to happen? Well, he's still going to have 1245 recapture, but at least he'll have sold the property, so he'll have the cash to pay the tax, right? But then any of the gain that exceeds the $5 million would be capital gain, okay? So what should we tell Mark to do? Please do a 1031 exchange of the property. Because if he does a 1031 exchange and he doesn't take any cash out, he has no net reduction in his liabilities. Does he have to recognize any gain? No. And then you just hold on to that new piece of property until you die. Your heirs inherit it. Fresh start. No recapture. Okay? Yes, Jane?
What if he dies? Do they get a step up on the 1245 category?
There's no change to the step up that occurred as a result of this provision. There's no recapture event as long as he held it for the 10 years. If he didn't hold it for the 10 years and they stop the manufacturing, there might be a recapture event that occurs, but that's only if they stop production. Yes?
Way back in the beginning, where he bought it for 7,
Yeah.
but it was worth 5,
The building was worth 5.
but he bought it for 7.
Yes.
Isn't that his cost basis?
So he paid $7 million for the entire property. What I was implying there in saying $5 million was building is that $2 million was land. Yeah. Yes.
When he does the 1031 exchange, does it change the property type from a 1245 back to a 1250?
No. When you do a 1031 exchange, whatever you had before as far as accumulated depreciation was concerned and its character follows into the new property. Yeah. Yeah. Okay. Yeah, no. There's changes for qualified sound production. If you have any clients who are in the music business, you may want to take a look at this, but we are not going to cover it here today. You want to talk about energy property? You want me to talk about it? Okay, so if you put solar on a rental property, or you installed solar on a piece of land or something like that, it used to be that it had a 5-year life. That was explicitly called out in the code for energy property. They changed it to be a 7-year class life, which doesn't mean that much anyway, because anybody who was buying that property was claiming what? Bonus or 179. So, you talk about this one?
Yeah, I'll take this one.
Okay.
All right. So we have some changes to some credits. We've got increases to our child tax credit For the last couple years, the child tax credit has been hanging out at $2,000. OB3 increases that to $2,200, so taxpayers who are claiming this credit are going to get a little bit of a bump there. And it also makes the $1,400 refundable component permanent. So that's very cool. The credit is also going to be adjusted for inflation, so we're not going to be stuck here forever. We're going to see some increases there. Now, for this one, this is a bit of a change here, because in order to claim the credit, we've always had to have certain kinds of requirements. But for this credit now, Social Security numbers have to be available for each qualifying child that you're claiming this credit for. So if there's an ITIN or something for the child, no credit. It has to be a Social Security number. And also, the taxpayer or their spouse has to have a valid Social Security number. So there will be taxpayers who had been claiming these credits in the past who will no longer be eligible for them now under these new rules. And this is effective for taxable years for 2025 and forward. So you may want to go through, if you have clients in this situation, and give them a heads up that this is a big change that's coming next year, this year.
This year, 25, yeah.
I talk in tax years, so 25 is next year. This is also very, very cool. The adoption credit has been around for a long time, but it's always been a non-refundable credit.
Before 2010 or around that time, there was a time period where some of it was refundable.
All right.
Yeah, but generally non-refundable.
For the last little while, it's been non-refundable. So if you had taxpayers who had qualified adoption expenses, then they could claim a credit for the amount of the expenses that they paid. But if it wiped out all of their tax, then they were out of luck. It would carry forward. But now we have up to $5,000 of refundable adoption credit. And so this is very, very cool. Effective for 2025 tax returns, years after December 31st of 2024. I'm really excited about this one. I think especially if you have clients who have special needs adoptions, this is going to make a really big difference for those taxpayers as well.
And if you have multiple, I think the $5,000 refundable amount applies to each credit that you claim. To each child. So if I adopted 3 children in a year, then I could get 3 $5,000 refundable amounts. All right. So I cannot tell you how much time I spent on these darn clean vehicle credits. I had written hours of continuing education classes on them, just like when I wrote about BOI, and then poof, gone.
We have a friend who is going to die mad about BOI.
Yeah, that's all he taught.
Yeah.
So same thing here, clean vehicle credits, poof, gone, but it's only for vehicles that were acquired after September 30th of 2025, okay? So if you bought in the first 3 quarters of the year, then you can still claim a credit for any one of these vehicles. Now, the IRS did something interesting, which I personally thought was contrary to what the code said. They said that if you had entered into a contract to buy the vehicle by that date, and you also put some money down, then you are deemed to have acquired it by that September 30th of 2025 date. So if in your book you see me say that you had to drive the car off the lot, according to the IRS, that is now not correct. You're going to look to see, did they enter into a written binding contract, and did they put any money down?
But they still can't get the credit until the car is placed in service.
Correct, yeah. So let's say there was a situation where you entered into a written binding contract on August 20th, and you put money down, and then you didn't get your car for 6 months later until 26. Yeah. I don't know how the forms are going to work for that, but we'll see. Also, for the energy efficient home improvement property credit and the residential clean energy credit, those go away if you don't place the property into service by the end of 2025, okay? Now, I know that in the code there's a weird thing where it says, hey, if you paid for solar expenditures in the previous year, they are deemed to be paid in the year where you placed it into service. That's what kind of creates a problem here. If you don't place the solar into service by December 31st of 2025, you don't get the credit, even if you paid for it in 2025. Yes?
When they say placed into service, I was led to believe that means you have to provide evidence it was
It needs to be operational. Yeah. So if you have clients who are, being sold solar right now, make sure that they can do it in the time period. Yeah. Nope. Nope, not to my knowledge. I mean, if you're under audit, they're going to ask you for whatever they're going to ask you for. But as far as what the law says, yeah, and the way they look at it, I can take one more question and then we got to move on.
You have a house that's being constructed in 2025, won't be done until 2025.
Sorry, no.
Geothermal system going in 2025.
Sorry, no. She said, we're building a house in 25, but it's not going to be done until 26. Sorry, no. I know. Sometimes that's just the answer, FICA tips?
FICA tips credit. So there's a credit that is designed basically to encourage employers to encourage their employees to report their tips. Because I don't want to shock anyone, but people don't really do that. In my opinion, there has always been no tax on tips because people don't report them.
Hey, but at least charged tips are cash tips, and those are being reported.
Yes, to an extent. Yeah, I worked in restaurants for a long time, so I know what goes on in there. But they want employers to encourage their employees to do it. But if I'm an employer and my employees are getting cash tips, do I want them to report those cash tips? No, because then I have to pay their FICA, and I don't want to do that. Well, for EIC as the employee, I might want to. But that's a separate thing. I'm talking the employer's side now. So they put in this credit that says, okay, listen, you get your people to report their tips, and then we'll give you a credit for the FICA that you pay, thus encouraging the employers to encourage their employees. And the big change here is that they expanded this definition, so now beauty services, hair salons, nail salons, things like that are included for the FICA tips credit.
I believe before it was only restaurants, right, Jane? Food and beverage. It was restricted to before.
Yep.
Okay, how many of you have clients who use the completed contract method or the percentage completion method? Okay, I'm going to talk to the two of you. Just real brief, okay? So generally speaking, when you have a contract that's going to run more than a year, you usually follow the percentage completion method. However, there was an exception if you were building single-family homes before. And you could use the completed contract method where you would defer the recognition of the income and expense until the year where you completed the contract. What they've done here is they removed the line that said single-family homes, and they substituted that for residential real estate contracts. So now if it's apartment buildings, they can qualify to use the completed contract method. Yeah. And for everybody else, it doesn't matter. Okay, COVID ERTC changes. How fun was this?
Woo!
I know. I've been talking about ERTC for years, and I'm sick of it. So what they did here, they created a new penalty for ERTC promoters where basically, hey, if you didn't keep the documents that you used to prepare the claim, you can be fined up to $1,000 per each failure.
But they made you commissioner of the IRS.
What was that guy's name? Billy Long? Yeah, I already forgot.
Billy didn't last very long, right?
See, if we didn't have Shannon, it wouldn't be funny. All right. They also did a thing where they basically said, hey, if you submitted a Q3 or a Q4 2021 ERTC claim and you didn't get it in by January 31st of 2024, then they don't have to pay your claim out, okay? But all of the other quarters, they're still required to pay those as long as you filed it by the end of the statute, which would have been 3 years after April 15th following the year that you were eligible. I'm not going to go into all this fun stuff. They increased the statute of limitations for those 2 years as well to be 6 years. Hello? There we go. They also amended the erroneous claim for refund statute to include these employment credits as well. So in addition to any other penalties you might face as a result of filing a false claim, they can also tack you with a separate 20% penalty as well. Okay, disguised sales and payments to partners. So this kind of relates to like the carried interest rule for like hedge fund managers or for people who are selling partnership interests for a living, where they basically attempt to like reclassify their income from ordinary to capital gain. And what they did is they just changed like 1 or 2 words in this statute for disguised sales. So that way the IRS's regs are like applied more strictly. I'm not going to go into it here, but that was a change that came out of the One Big Beautiful Bill. Do you talk about this one or do I?
I don't know, we didn't really talk about it.
I can talk about it real quick. How many of you have clients who are farmers?
Oh, wow.
Okay, so if you sell qualified farmland property and you have to recognize a gain as a result of the sale, you are allowed to spread out the tax liability that came from the gain over a 4-year period, okay? In order for it to be qualified farmland property, it's got to be located in the US. It has to have been used by the taxpayer as a farm or for farming purposes, or it has to have been leased by the taxpayer to a qualified farmer for farming purposes during substantially all of the 10-year period, ending on the date that they get rid of the property. So it could be for the farmer who owns the land or for the taxpayer who owned the land that was farmed on. And in the future, it also has to be subject to a covenant or some sort of a deed restriction that requires that land to still be used as farmland for the next 10 years after the sale.
That's got to be in the deed.
Well, yeah, it's got to be an actual restriction. Yeah. Yeah, if you sell to a developer, I'm sorry, it's not going to. But that's what they're trying to encourage you to sell it to other farmers, right? They've got information about qualified farmer in the text. The payment due dates for the quarterly payments that you make for that tax liability are by April 15th following the close of the year. Okay? So in the year that you sell the qualified farmland property, you would pay a quarter of that amount on April 15th of, let's say, 2026 for the 25 year. Then for your 2026 payment, you would do that on April 15th of 2027, so on and so forth. If you miss a payment by a day, the remainder of the liability becomes due at that time.
What happens if the person that owes the liability drops dead?
I don't know. I'm sorry. Oh, that's an exception? When they die, it accelerates. Yeah, okay, so yeah, the remainder becomes due upon death. There was a rule for that in there, wasn't there? Yeah, thank you, Jane. 20 minutes? Cool. I think we're about to get into the, oh, I literally had a bullet point. I'm sorry. I know, I'm bad. Okay, now we're into 2026 and beyond. We have 20 minutes to go through this stuff. Again, we wanted to push the immediate things that you need to know right now, and now we get into the stuff that you have to look forward to in the future, which we are going to fly through.
Yeah, we're just going to jam right through this. So we have the individual tax rates extended, and the 10% and 12% brackets are expanded. So we'll see more taxpayers have more income in those lower brackets before we make those jumps. If you die, your student loan interest can be discharged.
Wow, that's
And
the
you
one
don't
way-
have to include it in your income.
That's the one way you can get a discharge.
It is
if
the
you
only
die.
way you can
Yeah,
get out
you
of
have to
student
drop
loan
dead.
interest is by dying. So that's fun. We have increased limits for ABLE accounts, and we haven't really talked about the new Savers credit, but that's several years down the road. Yes.
Does that mean you have to die after January 1st, 2026?
January 19th of 2025. Yeah, you have to plan those things out. You got to be careful about it.
Keep them on life support. Sorry.
Exactly. You're like, just hold on. ABLE account contributions are now eligible for the Savers credit, which is, again, a couple years down the road. We're not going to go too deep into it, but that's something that's coming. It's going to be, I think, kind of a mess because the government is going to make contributions directly into these accounts, which I don't know how that's going to work mechanically. It's
God
going to
help
be
us.
very exciting, especially for our clients who don't even want to do direct deposit because they don't want the government to have that information.
They already have it.
They already have it. And we don't have a choice anymore. We can do rollover contributions from 529s into ABLE accounts. If you have distributions from a 529 account for eligible elementary or secondary education, that number has been bumped up from 10,000 to 20,000.
But that's only applicable for 2026.
Yes, everything we're talking about here is 2026 and forward.
Yeah.
Oh, you guys, the bicycle commuting exclusion is gone.
I know.
I know.
A
Moment of silence. Exactly.
Jinx.
Back to the death provisions of the student loan. Try using a bicycle in Manhattan.
Fair point. So no more commuting reimbursement exclusion. There is some increase to that dependent care assistance exclusion. So it's been kind of stuck at $5,000 for a long time. Now we're bumping it up to $7,500. So that's going to, I think, help out a lot of our taxpayers who are utilizing that exclusion. It's chopped in half for married filing separate, so $3,750 for our MFS clients. And there's an exclusion for employer student loan repayments. That's permanent and it's indexed for inflation.
That was the $5,250, where the employer could pay the student loans on behalf of the employee. Yeah, that's a permanent change. Okay, qualified small business stock. So this is a super fancy provision that we don't really see that often unless we do a lot of entity tax planning with our clients. So the idea here previously was, hey, if you get stock or you are issued stock after a particular date and you hold it for a 5-year time period and the entity's gross assets are not more than $50 million, then when you sell that stock, you can be eligible to exclude up to 100% of your gain, which was very fancy. The changes that they made here are that whereas before they had a maximum excludable amount of $10 million, they've upped it to $15 million and indexed it for inflation. But these changes are only applicable if you acquire the stock after July 4th of 2025, okay? I know, it's a bummer. They also, for the stock that they received on issue after July 4th of 2025, they increased the gross assets test up to $75 million. But the fancy thing they did is they changed the holding period requirements. So now, if you hold the stock for at least 3 years, you're eligible to exclude up to 50% of the gain. You hold it for at least 4 years, you can do up to 75% of the gain. And you hold it up to 5 years again or longer, you can do up to 100% of the gain. Yes?
And the whole business, whole company has to be sold. You can't just sell does the whole company have to be sold?
I don't think there's a requirement that all of the stock is sold to a new buyer. I think it's just the taxpayer needs to sell their stock. But I'm not, to be honest with you, I'm not 100% certain. Yeah.
Every shareholder gets 15, up to 15?
Yep, this exclusion is applied for each shareholder
Well, I have a
separately.
LLC client, tax as a partnership, they want to flip to a C corp now. They could get this.
There are weird rules about reorganizing your entity, but provided they meet all of those rules, then yeah, in theory, they could do that. Yeah, I am not an expert at qualified small business stock. I just wanted to tell you what the changes were. Okay, I guess I got to talk about qualified opportunity zone funds. So how many of you actually had clients who utilized these old rules for under Tax Cuts and Jobs Act? Okay, so really cool for the 5 people who used it. It should become more popular, to be honest with you. The idea here is that if I recognize a capital gain as a result of the sale of an asset, if I, within 180 days of the sale of that original asset, the creation of that capital gain, if I reinvest just some or all of that gain into a qualified opportunity zone fund, which basically holds and improves real estate in a distressed area, as long as I go in within the 180 days, I don't have to pay the tax on that gain. I get to defer it out. Under the old rules, you got to defer it out to the earlier of the date that you sold the Qualified Opportunity Zone Fund, or December 31st of 2026, at which time you recognize all of that deferred gain. What they did is they made Qualified Opportunity Zones permanent into the future, and they have this like 10-year like recurring or decentennial kind of recurring thing that happens with it. I'm not going to go too deep into the rules other than that to say it's nice that they extended this, but when we do updates for like 2026 returns, we'll definitely want to take a deeper dive into that. You want to talk about 2% and all that other fun stuff?
Yeah, we're going to have another moment of silence. Those 2% miscellaneous itemized deductions are gone forever. They were supposed to come back at the end of this year, but no dice on that. They were permanently removed. So anybody who's been sneaking in those 2106 deductions still or writing off the tax prep fees, all of those are gone. The educator expense deduction, I love this one because they come for this one all the time. Like the $300 is breaking our country's finances. But we've got the $300 educator expense deduction, and now any expenses in excess of that are deductible as a miscellaneous itemized deduction not subject to the 2%. So, you know, in the rare case where an educator is spending more than $300.
Only rich teachers benefit from this. If you're a struggling teacher, you basically don't get any benefit because you don't itemize, right? But if you're a rich teacher and you own a house and you pay a lot of state income taxes, then you get some extra benefit on Schedule A. I know, yeah, or the spouse. Well, that's still a rich teacher, right? Yeah. Okay, go ahead. I couldn't tell you how New York is going to handle that. I'm sorry.
Well, New York can still allow it as a 2%.
Yeah, if New York is still going to allow your 2%, then you don't have to worry about the 2% rule. But I don't know how New York conforms to other itemized deductions that are not listed above. But even if the 2% goes away, they're still going to have some line for it on the New York return if they're going to continue to follow that. I know.
Yeah. So this is an area of the session that I like to call girl peas, because we used to have the, I know, we used to have the peas limitation, right, before TCJA. So once you hit certain income levels, your itemized deductions would be reduced. And we sort of got rid of that for the last couple of years because there were so many other limitations. But now we have sort of a modified peas limitation back. And this is kind of wild, but really what they wanted to do was make sure that people who are in the 37% tax rate aren't getting any kind of a benefit for their deductions over 35%. So the way they did it was they said, all right, once you hit these income levels, then your itemized deductions are reduced by 2/37 of the amount of the itemized deductions or the taxable income for the taxable year exceeding that 37%. So basically they're making sure that if you're taking itemized deductions, the most deduction you can get is 35%.
Yeah, the most tax savings you would get on the deduction would be 35%.
Yes. So that's going to be exciting. The changes to charitable contributions are going to be really interesting, I think. It's going to be wild to try to track this. We have that 60% limitation for our cash contributions. That's permanent now. But we also have a new 0.5% floor. So all of our charitable contributions, when we're putting our Schedule A together, we have to look to the upper limitation, but we also have to chop 0.5% of our AGI off the bottom end. Now, here's where this gets exciting, is, you know, if you go over the 60%, the excess contributions carry forward, right? So you can use them in future years. That is continuing to happen. But what about that 0.5%? Does that seem like it would carry forward? The answer is maybe, because if you hit that upper limitation, then the lower limitation carries forward.
So whatever was disallowed under the 0.5% AGI floor, if you go over the AGI limit, will kick forward. But if you make like 30% of your AGI in contributions, you have to subtract the 0.5% AGI floor,
And it's
there is
just
no
gone.
carryover from there.
Yep. So that's going to be really exciting for all of us to track. We do have a return of the deduction for non-itemizers. So if you have, I know,
Yay.
this is exciting. I'm looking forward to this one.
How much is it?
It's $1,000 or $2,000 if you're married filing joint.
Wow, $1,000?
$1,000. Hey, listen, you know, I think this is pretty good because that's been one of the deterrents. I don't know if anybody works with nonprofits or does any kind of stuff in that field. That limitation, the increased standard deduction, I think hurt charities in some ways because a lot of people were like, well, if I can't get a deduction for it, why am I going to do it? Which I think kind of goes against the idea of charitable giving in some ways. But I think this will be nice because it will allow this benefit for people who don't itemize deductions, which is a lot of taxpayers now, and let them take that deduction. And I think will also boost contributions to the nonprofits again.
Yeah.
Hopefully kind of
And it's
get a
only
little
for
bit more.
cash.
Yes, not non-cash.
Okay, mortgage interest is going to stay at the $750,000 with all of the TCJA rules that we had for that. They changed the wagering loss deduction in an annoying way. If you are a losing gambler, there is no change. But if you are a winning gambler, you will be hurt by these rules. Because the rules say, for 2026 and for all future years, you can only deduct up to 90% of your gambling losses. Okay? So if I won $100,000 and lost $100,000 in the same year, I'd show the $100,000 of income on Schedule 1, but the Schedule A amount, I'd only be able to deduct what? $90,000, right? But if I'm a losing gambler, let's say I won $50,000 and I lost $100,000, 90% of $100,000 is $90,000, so I still get to deduct the full $50,000 against my winnings. Everybody see that? Okay. Casualty losses are permanently gone for personal casualties. There's some small changes to HSAs. QBI is permanent, but they increased that phase-out threshold for higher income taxpayers, which is nice. It went from $50,000 to $75,000, or $100,000 to $150,000 for married filing joint. And there's also a minimum $400 deduction that you can get if you have particularly low income from your trade or business. What else do I want to talk about here? They increased the child and dependent care credit to be a max percentage of 50%, but it will phase back down to 20% as the taxpayer's income goes up. For education credits, you now have to have a social. The new markets tax credit was made permanent. There is a tax credit that exists for businesses who provide childcare to the employees. It's a very complicated credit. It used to be a 25% credit. They increased it to be a 40% credit. The premium tax credit in 2026 will not be available for certain ineligible aliens. To be honest with you, I can't tell you who an ineligible alien is because it starts to go into like immigration law and it starts to get a little weird.
There is another thing on premium tax credit though that I think is important to talk about, and that's if you had clients who were overstating or understating their income and figuring, I'm just going to take advantage of that repayment limitation, the repayment limitation is gone. So they will have to repay the entire premium tax credit that they got that they shouldn't have. So that may be something to do a little bit of planning for your taxpayers who do that consistently and let them know that's gone now and the full amount has to be repaid.
If you have a client who has a business and they have a paid family or medical leave policy in place, they will continue to receive a credit when they make payments to those employees under that plan. They also increased the credit percentage and they expanded the plan a little bit. They're creating a new tax credit where if you make a contribution to a scholarship organization to like help fund a grant program for people who need it, you can get a dollar for dollar tax credit when you contribute to that up to $1,700. There are limitations, but again, that'll be talked about next year. Okay, let's talk about these things called Trump accounts. We got to talk about them. I'm sorry, I can't not, because everybody wants to know about them, right? Now, you could call these by the code section if you feel uncomfortable. I'm just going to call them Trump accounts, and if you don't like that, then
Is it 430A? Is that what it is?
530A.
530A.
Yeah, 530A. So I'm going to just go over Trump accounts briefly here. Originally, these were set out to be this account where you could make contributions and then you could pull the funds out to start a business, buy a home, for education, for all that fun stuff. And then the Senate basically like neutered the whole thing. And so now what these Trump accounts are, it's a tax-deferred account. When you make a contribution to it, you do not get a deduction. But it basically functions as a traditional IRA, okay? Now, the contributions that can be made can be from family or friends, but the total contributions are limited to $5,000 per year from family or friends. Employers can contribute money to these accounts. And then also state and local governments can make contributions, and the federal government will do a special $1,000 contribution if you were born from 2025 through 2028 and an account is set up. The Trump accounts can only be set up for individuals who are under the age of 18. You are not allowed to pull any money out at all until you reach the year in which the beneficiary turns age 18, okay? When the money comes out, taxable, subject to penalty, unless you qualify for like a traditional IRA exception for a penalty withdrawal. I think that what will happen with these accounts is that they will come in and revamp them to add in all of those, qualified withdrawal things. I think that people should still set up these accounts even if they're not going to put money into it. Because if you set up the account for the child, they either will qualify for the $1,000 contribution if they were born from 2025 through 2028, or they will qualify for the contributions from state or local governments, which are going to be made randomly, and who knows how they're going to pick the people that they make those contributions to. It's a very odd program. You won't be able to set up one of these accounts until July 4th of 2026, so we still don't have a lot of information on how all of this is going to work. The AMT exemptions are basically kept at their higher level, and so are the phase-outs. They expanded the definition of a publicly traded partnership to include different types of industries. They increased the estate and gift tax limitation up to $15 million indexed for inflation. Shannon, what happened with 1099Ks and other 1099s?
So 1099K, retroactive back to the old rules, 20,000 and 200 transactions. And everything else goes from 600 up to 2,000. So we'll have fewer people receiving those other 1099s and a lot fewer people probably receiving the 1099K. They may still get them because that only means that they have to send them. And I've seen people get those for much lower amounts than that, but that's when they're required.
Yeah. Remittance transfers. If you've got a taxpayer who sends cash or money orders, or there's one other type of payment, to another country, there is an automatic 0.5% remittance transfer tax that will be assessed on those amounts. But if you simply wire the money to another country, you won't have to worry about that. It's just for the cash transfers and the money order transfers to foreign countries. And then there was a change for exempt organization compensation, which we are not going to talk about. So we are a couple of minutes over. We're going to stay up here, so if you have any questions, you can come and ask us. And I want to thank you all so much for having us. You guys are a great group. And I don't know if you have anything else do you guys have to say anything? Cool.